I will quickly invite Suresh now to speak on his experience for structuring for taxation. A little different flavor than what has already been said, but quickly so because we're running behind the time. Suresh, as you know, he's the president of TIE. He's also the executive vice president and portfolio manager with Caliber Management Incorporated. He manages equity funds focused on investing in emerging growth companies. Previously, Suresh has worked with one of the big fours as well as with Reitman family managing their multi-million-dollar family money. He has about 30 years of experience in North America, Middle East, and South Asia. He's also the chairman and director of IIM US Incorporated, a pan-American organization for all the IIMs. Suresh has had a brilliant academic record. He's an engineer, he's an MBA, he's CFA, and he's CIM. And in all the degrees that he attempted, he got gold medal. I invite Suresh to speak. Very grateful.
Humble again.
Well, Lalit, thank you. Thank you to Greg and Nancy. Actually, they made my task very easy because they covered a considerable amount of ground, and I really don't have to say much. So I will be very quick, and I will not take too much time because you have to all get to wherever you come from. Well, my focus is going to be primarily on tax efficiency. Lalit did cover some of my background. I am not a tax expert. I have only advantage of working with startups and small companies. I've seen their structure, I've seen the legal agreements they've gone through. So my experience is based on a number of legal agreements and all the hard work done by attorneys like Greg and Nancy, who have actually designed those. So my experience is only trying to give you an overall flavor. But tax planning is a very, very complicated question. And if you have questions specifically on Dutch sandwich or any other strategy, I will ask you to direct them to both Greg and Brown. Fasken has been a huge, huge supporter for entrepreneurship. In fact, they are the sponsors of today's session, as you know. They also sponsor consistently TiEQuest Business Venture Competition for many years and with prize money. But more importantly, they give pro bono help and guidance to our winners every year for a number of hours Greg spends with the winner. And last year they gave a program where they gave as much as 90% discount to the TiEQuest finalists over their regular billing rate. So that's a huge, huge help. So I will encourage you to speak both to Greg and Nancy on not just tax issues or any other issue. From my experience, this is a graph of an overall cash flows for an entrepreneur. In year one, you spend some money to try to build your company. Year two, you spend some more. You don't take any money out, you spend some more. And then maybe in year three, you get some investor, but investor wants you to spend some more on your company. So you end up spending money in your company. Maybe you draw a little bit of salary. And year four, you draw some more salary, but pay a little bit of tax. But still you put additional money from your own pocket in your company. And then if everything works out, in year five you've sold the business, say for $20 million. So you get, that's the reward the entrepreneur is working for. And that's a really successful award. And you get $20 million, you buy a couple of homes and holiday home, maybe a yacht or something. And then you come back after your world tour and you find that there is a tax bill of $4 or $5 million. And suddenly, all the cash you were left with at the end of that sale has gone to the tax man, and you're back poor again. You don't want to do that. So you want to find strategies where you will have to pay less. A very successful Canadian businessman said that it is the stupid who evade tax, but it is the fool who pay them. So you got to decide whether you want to pay taxes or you want to evade taxes. So there are strategies available to help reducing tax and also deferring tax, so that at the end you will have to pay overall significantly less. If you just taking the example of building a company for 4 years and then selling it say $20 million and then ending up with $4 or $5 million tax, you could design strategies where your tax liabilities could be less than a couple millions. You cannot totally avoid it, but you have to think through those tax strategies upfront, because under Craig and Nancy will tell you more clearly, under tax regulations, if you do something just before sale, that's not valid. You must, whatever structures you want to put, you must put into those structures at least for 2 years before the sale to take advantage of many of these tax planning strategies. One simple strategy is choosing an year end. You don't have to have, as individual, we all have to file our return based on our income from January to December. Corporation does not have to follow that particular calendar. A corporation can have an year end which is different. For example, I have a corporation where the year end is in July. So any income my corporation earns from 1st of August to end of July, I prepare a tax return, or my accountant prepares a tax return, and he files. So I do not draw any income from that corporation during the course of the year. But come January, 6 months down the line, the corporation gives me all the profits as a dividend to me. So resultingly, I pay tax on that dividend income a year later, because the income came to me in January. So I have to file a tax return a year later. So I have technically been able to defer my tax by nearly 1.5 years, simply using a strategy which is a year end. Now there are limitations on what you can do, what calendar year you can choose, and can you change it after you have incorporated. So you'll have to consult your attorney to find out. Now the question will be, there are a number of other strategies. Craig did mention about small business incentive, small business reduction, but there are ways further on creating pass-through entities like trusts or like limited partnerships, where you can shelter tax in a number of ways. Also there are strategies. I've just done a little bit of comparison for tax purposes. When you draw income from your business, you have an option to draw income from your business as your salary. Or you can draw that income as a dividend. But when you draw the income as a dividend, first the company will have to pay corporation tax. And then the net profit, whatever is left, you can take it out as a dividend. Under tax regulations, the total cost of payroll tax versus corporation tax and dividend tax are not hugely different. But the key advantage is deferral. You have to pay much, much later, which helps you essentially save tax in the overall. Now, if you create a company where you have a strategy where there is a company and that company is owned by another holding company, and the holding company is owned by you. So what happens is, if you don't need the money, then holding company may not have to pass on that dividend over to you. So so this dividend will not be taxed if it has not been given to you. You decide how much money you need to run your day-to-day expenses and decide how much you want the dividend to be paid to you. Dividend can be delayed, and therefore you will defer the tax using that type of strategy. Now, how many of you have shares of your own company? Probably everybody, right? And how many of you have RRSP? Quite a few of them. Now, does your RRSP own shares of your own company? RRSP is a tax. We have a tax advantage. You don't pay tax on any income. If ultimately this company gets sold and there is a capital gain, the capital gain will go to the RRSP account, and therefore you will not have to pay capital gain tax on that portion of the account. So there are ways and methods. I know one of the tribe member who has an RRSP of $8 million. How come? $8 million is because he had put initially shares of his own company into his RRSP, but there are limits you have to do within those limits. And then he sold that business. There was a substantial capital gains tax. He started another business, again put some shares into his RRSP, and over 3 ventures he has built a good, very healthy retirement life for himself over an $8 million. So there are now the tax-free saving account. How many of you have tax-free saving accounts? Great. You could buy shares of your own company, can be purchased out of your tax-free saving account. and that will help you save the strategies. Greg mentioned about capital gains exemption of $750,000. Now, if you own shares of your company, all 100% yourself, then you get one capital gains exemption. But if these shares are owned by both you and your spouse, you can get two capital gains exemption. Now, if these shares are owned by a trust, which has beneficiaries of yourself, your spouse, your children, your parents, and anybody else you can include, you can get 10 tax capital gain dividend exemption. So if you sold your business for $20 million, you can get $7.5 million of capital gains exemption. So the tax is only on the remaining portion. But these things have to be thought through well in advance, because you can't do those things unless you plan ahead. So it's very important to see that you meet your attorney and discuss these issues much more clearly. So don't do the way Dilbert has recommended here. You need to consult your attorney, and you need to consult them now when you're trying to structure your business rather than going into later. Well, we cannot avoid taxes. We have to pay taxes because entrepreneurship is for profit, and ultimately we are there to make profit, and therefore taxes are important. So I hope I was brief, and I'm not going to take any questions because we have experts here. So if you have any questions on this, you can please direct to Greg. Thank you.